Hey everybody, Curt from markmoney.com. Today we're going to talk about 5 disadvantages of Roth IRAs. Alright, disadvantage number 1, no tax deduction on contributions. Traditional IRAs, traditional 401ks allow for a tax deduction for anything you put into the account. So if you put $5,000 into a traditional IRA or 401k, it's your $5,000. On the other hand, let's say you want to put $1,000 into a Roth and your tax bracket is around 10%. So you're going to have to put in, actually it's going to cost you more like $1,100 to get $1,000 into the Roth IRA because you're going to have to pay tax on that original balance. So when you put money to Roth, it's actually less than you started with. If all things are equal over time, traditional or Roth, and this is an important mathematical principle to understand, if taxes are the same on both ends, let's say you're in the 22% bracket when you make contributions and you're the 22% bracket when you make withdrawals, the total amount coming out of the account is going to be the same. Easy example of this is if you have $10,000 and you put into both accounts, and let's say that money doubles over some given period of time, and you're in the 20% tax bracket. In a traditional account, you put 10 grand in, it doubles to 20 grand. All right, you're taxed 20%. That means you have 16,000 left because you're going to pay 4,000 in tax when you make the withdrawal. A Roth, on the other hand, let's say you're taxed at 20%. You put $10,000 in. You're actually going to get 8,000 into the account because you're going to pay 2,000 in taxes. But when 8,000 doubles, you still get the same 16 grand. So all things equal tax-wise, it kind of washes out. Disadvantage number 2 of a Roth IRA is that deductions and withdrawals both come from the top of your income tax bracket. To begin with, we live in the United States and we have what is called a progressive tax system. And basically that means that our income taxes build as we make money. So the first, around $10,000 you make, I think, is taxed at 10%. The next little bit is taxed at 12, and then 22, and then 24, and then 32, and on up. And the money that you make within those ranges is what's taxed at that level. So the first dollars you make are always taxed at 10%, and the next chunk, they just stack on top of each other. It's not as if you top out at the 22% bracket, that every dollar you make is taxed at 22%. It's only the dollars that are in that range. Well, if you make a Roth contribution and you're in the 22% bracket, you're paying tax at the 22% rate because that is where the deduction would have come from had you made a traditional contribution. So in the case of the traditional contribution, let's say you put $5,000 into a traditional IRA and your income from the year was, we'll go, you're single, your income's $90,000, that's going to put you in the 22% tax bracket, I believe. So if you put $10,000 into a traditional IRA and you're that age and you're in that situation, and your tax deduction is going to be $2,200, right? Now back to the Roth. When you get to retirement and you're making withdrawals, there's no tax implication at all, right? All the tax has already been handled on the front end. But when you pull out traditional money, instead of it being taxed at the top amount, because remember, when traditional is pulled out, it's going to be taxed. But initially, that money is going to come from the bottom because you're not working anymore. You don't have income from your job if you're retired, right? That means the first dollars you pull out, and you may have some Social Security income, you may have some pension income, that may raise that. But odds are it's going to be lower than when you put it in. So if you're pretty confident that your tax rate in your building years, the years that you're contributing to an account or a Roth IRA traditional, is the same as it's going to be when you retire, then it does matter. Traditional is probably a little better. So since Roth contributions and withdrawals always come from the top of your progressive tax, that's actually your marginal tax rate is what we call it, Roth IRAs are kind of at a slight disadvantage to traditional IRAs. This is not something I've seen talked about a whole lot, but it matters. It absolutely matters. So keep it in mind as you sort of process this information. Hey, if you haven't already, please click the like and subscribe button below. It helps get the word out about our channel, helps it grow, helps other people learn about finance with us. All right, disadvantage number 3 of a Roth IRA is the contribution limits. You can only put $6,500 into a Roth IRA in 2023. You can put up to $7,500 if you're 50 and over. But if you've got a lot of income and you're trying to save a lot, that's not a ton of money. 401ks, go up to $22,500 in 2023 for tax advantage saving. and then they go up to 30,000 if you're 50 and over. So there's a much larger, 3 to 3.5 times more volume that you can put into a 401k than an IRA, which makes them a little less advantageous if you're trying to save a lot. All right, disadvantage number 4, income restrictions. If you make too much money, you cannot contribute money to a Roth IRA. We'll put some ranges on the screen here. Basically, at some point, the IRS is going to say that you're too wealthy to put money into a Roth IRA, which is understandable. They're generally created to help lower income folks with retirement saving, and that's fine. So it's going to be a restriction if you have a high income. Now, there is a workaround called a backdoor Roth IRA. Basically, you can contribute to an IRA on an after-tax basis and then convert that money into a Roth, and that's a way to get it in there. Now, loophole's been open for years. It's not illegal. Anybody can do this. The government has, I guess, found it, satisfactory enough not to mess with it. So for now, you can still contribute to a Roth IRA through a back door. If you do that, please pay attention to the pro rata rule. If you have a traditional IRA, there's a chance you could create a huge tax liability if you try a backdoor Roth. Basically what it says, the pro rata rule that is, it says if you have a traditional IRA or any funds in an IRA that haven't been taxed and you do a conversion, the IRS is going to tax you on a pro rata basis of the value of your traditional or tax deferred investments or accounts versus Roth. So keep that in mind. Disadvantage number 5 of a Roth IRA is early withdrawal penalties. Now, on a Roth IRA or traditional IRA, either one, you have to wait until you're 59 and a half to make withdrawals. If you have a 401k though, technically you can begin making withdrawals at age 55 under the rule of 55. It applies if you retire from the company that holds your 401k at 55 or later. You can begin making withdrawals penalty free, and then the taxes will apply depending on the tax basis of the account. There are a couple of ways around this age restriction for Roth IRA withdrawals. The first one is a Roth conversion ladder. You can basically take traditional IRA funds, convert them to Roth. They have to sit for at least 5 years before you can begin making withdrawals. But once that 5-year window is satisfied, any converted amounts the IRS sees as a contribution. Another way around the 59.5-year-old age requirement is to use Rule 72T. That's basically where you set up a series of equal periodic payments or withdrawals from your Roth IRA or traditional IRA account. It works for 401k, IRA, whatever. And basically, you set up a system to make withdrawals over a defined period of time until you reach age 59 and a half, or a period of 5 years, whichever is longer. Now, these are really complicated to set up, and if you run afoul and mess something up and take the wrong amount out, you can get in big trouble with the IRS. So if you do go that route and investigate it, please reach out to a financial professional like an accountant to help you set that up. Because it's pretty important that it's done well. All right, we've been knocking on Roth IRAs. I do want to give you a few advantages to Roths before we wrap up. First advantage I can think of is tax-free withdrawals. They grow tax-free in retirement. You get the money out, and the government is no longer your partner in your retirement plan, which I think is pretty great. Advantage number 2 is access to the contributions. Like we already said, Roth IRA contributions are always available, penalty-free, tax-free. You can always get those back out of savings. So if worse came to worse and you needed that money, you could get it. Advantage number 3 is Roth IRAs do not have required minimum distributions. So when you reach retirement age, or age 75, which is when you have to take required minimum distributions in a 401k or traditional IRA, you don't have to worry about that in a Roth because they're not required. Another advantage of Roths is tax diversification. It gives you options in retirement when you're making withdrawals. You can take some tax-free, you can take some tax-deferred, and it gives you a lot of control there. You can also use Roth IRA dollars for college. So if you are funding your education or someone else in your family, you can make a withdrawal penalty-free and use that money for education. You also get more investment options in a Roth IRA. In a 401k plan, you're kind of limited to whatever your employer provides, right, through their custodian. In a Roth IRA, you get to choose your custodian, you get to choose what investment types, gives you better access to lower cost investment options and equities. And the last thing about a Roth IRA is they are the absolute best way to receive an inheritance. And the reason is, after an IRA is inherited, the named beneficiary has up to 10 years to remove that money from the Roth IRA account. So let's say you pass away, you have a Roth IRA, they receive it, they don't have to remove that money immediately. They can let it sit for 10 years, and it can, all the earnings and anything it grows in that 10-year period, they get to remove the 10th year completely tax-free. All right, there's 5 disadvantages to Roth IRAs. Don't let that deter you from opening one. basically, if it makes sense from a tax perspective, you should totally use a Roth IRA. They're a great instrument. They give you a lot of control of your tax situation as you age and when you reach retirement, and that's never bad to have. We got a lot more information about Roth IRAs, traditional IRAs, 401ks, all this stuff at markmoney.com. We'll put some links in the description below to some other posts and videos we've done about this topic. As always, we appreciate your interest in our videos. Thanks again, and have a great day.